Welcome to the Explainer. Today, we are breaking down a truly paradigm-shifting comparative analysis that directly challenges pretty much everything we've been taught about building wealth. We're going to run a 10-year projection, taking a flat $350,000 and allocating it entirely across 4 completely different investment categories to see exactly how the wealth creation stacks up. So get ready to seriously rethink your portfolio. Okay, here's our roadmap for today. We'll start with the mortgage trap, move into the 5-year ROI target, crunch some Bahia reboot fractional math, look at the Chalet asset collection, explore the Coastal Horizons vision, and finish up with global investing made simple. Let's dive right in. Section 1, the mortgage trap and why we really need to rethink domestic real estate. For decades, we've all been sold this idea that buying a house is the absolute ultimate safe haven investment. But the source transcripts we're looking at today, they do not hold back. They actually reframe the standard 30-year U.S. mortgage not as a point of pride, but as an illusion. They literally call it a low-yield trap, or even a slavery system that just locks up your capital indefinitely and restricts your global freedom. Let's actually run the numbers using our $350,000 baseline. If you take that full amount in cash and dump it into a traditional U.S. house, and we're assuming a standard 3% annual appreciation here, but we gotta subtract 2.5% every year for taxes, insurance, maintenance, the whole shebang, your net profit after 10 years is, well, a pretty underwhelming $32,500. That is an annualized return of roughly 0.9%. Now, compare that to just renting your primary residence and putting that exact same $350,000 into a standard diversified portfolio. Assuming a historical 7% return, that yields a massive $338,000 profit over the exact same decade. So buying a home in cash is stable, for sure, but financially speaking, it's incredibly low yield. Moving on to Section 2, the 5-year ROI target, and how to accelerate your returns. So if the traditional route is kind of trapping our money in slow motion, how do we escape? Well, the sources propose a radical mindset shift. Stop thinking in decades. They introduce what they call the 5-year rule. It's a philosophy that says, hey, if an investment takes more than 5 years to give you back your initial capital, you should get out of it, period. It's all about prioritizing rapid, high-yield capital velocity over traditional long-term debt. That brings us to Section 3, Bahia Reboot Fractional Math, and unlocking some truly extreme cash flow. Now, to actually find an asset that hits that aggressive 5-year target, we really have to look beyond domestic borders. The Bahia Reboot ecosystem is super interesting because it blends lifestyle design with wellness, but the real magic is in the financial mechanics. It uses a fractional model, which lowers the barrier to entry for international investors, while aiming for a massive 10.7% projected return on the chalets themselves. And the math on this fractional setup is just fascinating. As the investor group for a single chalet shrinks from 5 down to 3 owners, your personal benefits scale up dramatically. Look at that 3 investor tier. Your personal usage jumps to 17 weeks a year, and your annual net income hits $10,700. And that is all off just a $20,000 entry. Let that sink in. That translates to a staggering 53% annual cash-on-cash return. Let's bring back our $350,000 test budget. At $20,000 a share, you could scoop up 17 shares. Those shares would generate over $181,000 annually. Over 10 years, even if we conservatively assume zero appreciation on the property itself, your total profit projection is an unbelievable $1.82 million. Plus, you technically hold 289 weeks of yearly property usage. Out of all our scenarios, this is absolutely the highest cash flow generator by a massive margin. All right, Section 4, the Chalet asset collection. Let's talk about tangible luxury sanctuaries. Because, this isn't just a fun spreadsheet exercise. You are securing deeded sectional title ownership in physical luxury real estate. These structures use biophilic design, meaning they integrate nature, and they're built with natural materials like Macaranduba hardwoods to create a genuine private sanctuary. From single layouts all the way up to family suites, they are built with reinforced structural systems so they have serious long-term eco-resort resilience. You're really buying into a living ecosystem here. The whole Bahia Reboot philosophy is centered around human flourishing. We're talking about a regenerative retreat complete with swimming pools, swim-up bars, a dedicated yoga deck, and entirely organic local artisanal guest services. It's a sanctuary quite literally designed from the ground up for maximum well-being. Next up, Section 5, Coastal Horizons Vision. let's look at the ecosystem and the long-term play.
While those chalets handle the immediate cash flow, the Coastal Horizons land is really the long-term appreciation play. Let's frame this up using risk-adjusted return, or RAR, to compare all four of our investment options. If we take our 10-year profit and divide it by the asset's risk level on a 1 to 5 scale, the picture gets super clear. The U.S. house is the safest, but that low yield leaves it with a tiny 16K RAR. The diversified portfolio is incredibly balanced, sitting at 113K RAR, but wow, the Bahia chalets completely dominate with a massive 455K RAR, while the raw Coastal Horizons land performs really well with a strong 95K RAR.
And let's zoom in on that land appreciation for a second. If you bought 17 raw lots with our $350,000, the math gets really compelling. Even in a worst-case scenario, say just 3% annual growth, you still profit $150,000 over a decade. The base case, projecting a realistic 8%, yields a $381,000 profit. But the best-case scenario, if the gated community and the whole eco-sustainable vision of Coastal Horizons fully materializes and foreign investment flows in, that profit rockets well past $700,000.
Finally, Section 6, Global Investing Made Simple, bypassing the red tape.
Now, you might be thinking, okay, but international investing sounds like a bureaucratic nightmare, right? Well, the sources actually dismantle that myth completely. Normally, buying property in Brazil means you have to travel there, deal with the government, and secure a local tax ID, which is called a CPF. But, and this is a real game changer, by purchasing a fractional share through the established Bahia Rebutte entity, international owners can completely bypass that hurdle. It removes the absolute biggest point of friction, providing you with deeded equity and distributing your passive income quarterly with total transparency. So let's pull all this together. What are the big takeaways? Well, for the most stable asset, the traditional U.S. house definitely wins, but you totally sacrifice yield. If you want a liquid, balanced approach, the diversified portfolio is your best bet. For massive appreciation potential, especially if that gated community vision comes to life, the Coastal Horizons land is the clear play. But for the highest total wealth creation and absolutely unmatched cash flow, generating a projected $1.82 million in profit on a $350,000 investment, the Bahia Rebutte chalets just rewrite the rules entirely. They offer a 53% annual cash-on-cash return. The data is clearly pointing toward a new paradigm of high-yield, purpose-driven global assets. So the question I'll leave you with is this. Are you going to stay in the traditional low-yield trap, or are you ready to explore a regenerative financial future? Thanks so much for joining me on this explainer, and I'll catch you next time.